Welcome to Factful Finance. Did you know that most investors struggle with market volatility, often making decisions based on emotions rather than strategy? Let's dive into a proven strategy to minimize that emotional roller coaster: dollar cost averaging. Before we get started, a quick disclaimer: the content here is for educational purposes only. For personalized advice, be sure to consult a professional. Now, let's break it down. Dollar cost averaging, DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. The idea is simple: invest consistently over time, and you'll avoid the temptation to try timing the market. Here's why it works. When the market is down, your fixed investment buys more shares. When the market is up, you buy fewer. Over time, this strategy can help reduce the impact of short-term volatility on your portfolio. Let's consider a real-world example. Imagine you're investing $1,000 a month into an index fund. In 1 month, the price per share might be $100, meaning you buy 10 shares. The next month, the price could drop to $80, so you can buy 12.5 shares. Over time, this averages out your cost per share, potentially lowering your overall risk. And it's not just about reducing risk, it's also about removing emotion from investing. Research shows that investors who try to time the market often miss out on gains because they let fear or greed drive their decisions. With dollar cost averaging, you're focused on long-term growth, not short-term fluctuations. You can set up dollar cost averaging with as little as $50 a month, making it accessible for nearly everyone, regardless of your financial situation. Many brokerage accounts and retirement plans allow you to automate these investments, so you don't even need to think about it after setting it up. Experts recommend DCA for beginners because it helps smooth out the ups and downs of the market, and it's a great way to start investing without feeling overwhelmed by the complexity of market trends. So how can you apply this strategy? Start by determining how much you're willing to invest on a regular basis, whether it's monthly, quarterly, or another time frame that fits your budget. Choose an investment vehicle, like an ETF, mutual fund, or retirement account, and let your strategy work for you. The beauty of dollar cost averaging is that it doesn't rely on trying to predict what the market will do tomorrow. Instead, it's about consistency and patience, key pillars of long-term wealth building. Now I want to hear from you. Have you used dollar cost averaging in your investments? Or are you thinking about giving it a try? Let me know in the comments. Thanks for tuning in to Factful Finance. If you found this video helpful, don't forget to like, subscribe, and click the bell to stay updated on our latest financial tips. Let's keep your money working for you.